Welcome in studio for Marketplace. My name is Eric Halbert. That is David Wright of Wright Financial. David, thank you so much for being here.
Thanks, Eric.
In real estate, it's location, location, location. When it comes to money, it's taxes, taxes, taxes. That is dangerous. It's scary. It scares some people, doesn't it?
It does. So how many out there, I want to see a show of hands, how many out there thinks taxes are going to reduce in the next 10 years? Yeah, I'm not seeing any hands.
No.
Most of you have accumulated your wealth through 401k contributions, IRAs, or whatever your company may have offered you. At some point, the IRS is going to, come after you and knock on the door and say, we want our fair cut of this. So what can you do in advance to prepare yourself for that taxable hit at some point? And I would say the earlier the better. If you can get into an advisor, a tax advisor, or an income advisor, and start analyzing what the impact of your investments are right now on your cash flow, there's things you can do to take control of the situation.
So it's almost a save versus keep plan, isn't it?
It really is, and that's why a lot of the younger generation, their planners seem to get it. They're doing more Roth IRAs, but a lot of us older folks were told, put pre-tax money into your 401k, grow the balance. Well, now that we're here, there's some things that we can do. Some active tax planning to control the controllables, like how much do I have in my tax-free bucket? If I don't have enough in my tax-free bucket, what can I do now to create a larger tax-free bucket by paying the IRS a little bit now, maybe while I'm working, while I have more cash flow? The second bucket, tax-deferred bucket, that's all the 401 IRA accounts. Can we slide some of that money into Roths? The last part of this is your taxable buckets, your savings accounts. But if you can control distribution from all three of those buckets and plan for it, you're going to have a much better outcome. The thing that I see that happens more often than not, Eric, is that people come walking into the office when, they're already 72, 73 years of age, and they're getting ready to start withdrawing, and they want the tax plan. It's not that you can't do it.
Right.
It's just, is it maybe a little late into the game to be able to make those changes to pay less to the federal government?
Thank you, David. Inside the 13 ABC Marketplace, I'm Eric Halbert.